My due diligence process on operators and who I work with is 50% the person and 50% the numbers. So the person is, I've gotten burned a couple times with just investing off of some, random email or daisy chain deal, or I put this or in one case, a self-directed IRA recommended to work with this certain operator. And that's just that you shouldn't do that.
I was
And
going to say that's typically they try and avoid that situation. They
yeah,
sort
this is back in 2012. I don't even know if
of
this company is still in business anymore. So I forgot which company it was, but I mean, as an investor, you want to build up your network of other passive investors. Talking to syndicators and operators does you no good. It's a waste of time, in my opinion. I mean, I can talk about this stuff in my sleep. If you're a passive investor, you want to find other high net worth passive investors to build real relationships with and figure out, you want to have those conversations that, hey, you put in 50, 100 grand with this guy. What actually happened? Right. And unfortunately, when you're starting out, you don't bring any value to that conversation. So it's going to take a while to get going. And the local RIA or the online forums are some of the worst places to go to, because you're just a bunch of broke people on that stuff. So I don't know where to go. I can't really give any practical advice on that, but
Mhm.
you've got to get around high net worth accredited guys and guys who are actually doing this stuff, that don't have a dog in the fight in terms of getting some kind of marketing fee or referral fee or whatever, and go off of that. That's the gold standard. Like, I mean,
Mhm.
people will bring me deals all the time, and I'm like, well, first question, you know what I'm going to ask? Who the F is this guy? How do you know him? Have
Mhm.
you invested with them in the past?
so
Um,
that's an interesting take. 'Cause I don't think most people they like to flip to the back page and see what the return is, and then they invest, and then they've made their own bed, right? Whatever happens, happens. I think it's very important to talk to other investors and find out where they're having success, right? Because that's you want to go back to the well, and you don't want the well to dry up. And if they're investing with someone over and over and over again because they're proving it out, those are people that you want to invest alongside with. You said, they say your net worth is similar to the five people you're around. So it's an interesting take on investing, because most people say, well, just keep looking at different deals and underwrite the deals. But I always make the argument that, the person that's going to battle for you, that's probably at least 50% of the battle, right? The deal is the deal, whether it's a good deal, bad deal, that's for another conversation. But who's the team or the man behind the deal or woman behind the deal? Because that's what's going to make the deal work, right? It's how they can manage an onsite. It's you know, how they buy it, how they found it. And I don't think people weigh that nearly high enough, um, when people just want big, huge, massive returns, and they're not asking themselves those questions, because those are the questions that are really going to matter when things don't go well.
yeah, I mean, I think like a lot of the podcast advice or the top of the um funnel advice is like, invest with the right people, right? But if you're new, who the heck is a good person, right? Who has
Mhm.
the best fan likes on Facebook or something like that? You don't
Uh-huh.
know, right? And oftentimes the people who are good at marketing aren't the best operators. I mean, you can't be good at both. I mean, you shouldn't be good at both. If you're good at operating, you shouldn't be screwing around with a really good marketing scheme.
Mhm.
So the other half is the numbers, right? But unfortunately, when you're looking at a pitch deck, there's nothing in the pitch deck that tells you if it's a good deal or not. I mean, there's very little times that the operator will even put in reversion cap rates, what full economic occupancy is, what is the rent escalators per year.
Mhm.
Um, and luckily, I know how to underwrite the deal, so I can cut through all the garbage and
Right.
decode the code. But I would say 95% of LPs do not know how to do that, which is why I see the whole thought behind, investing with the right people, because that's all you got, right? But if I'm saying, well, if you're gonna do that, you can't underwrite the deals. You're gonna invest with the people. Just make sure you invest with other people that you trust, that have vetted them in the past. It's kind of like, it's kind of a silly analogy, but like, you come to an intersection and the other guy on the left side is making the left turn. You can't see past that car, especially if it's a truck, right? And you're trying to make the right turn.
Mhm.
You know, if they're gonna go, you figure that they checked and they're gonna, their driver's side that's gonna get whacked, right? So I go.
No, I know exactly what you mean, right? And it's also too, if they're going, they're also shielding you a little bit too.
Yeah, exactly. Or we could all be screwed.
Yeah.
But that's small chance of happening, right? And for accredited investors, unfortunately, in the beginning, you just got to take a chance with 50 grand. I mean, it sounds very reckless and irresponsible, but that also helps you build up a track record and some, good or bad deal. Even bad deals is good to have in the beginning, because now you can use that to build a relationship with another accredited investor, and you have some war stories to talk about, and you have some value to bring to that interaction.
I joke around, but I'm not really joking. I tell people the best thing you can do potentially for any individual is lose money. I mean, invest in something and it not go well, or buy something and mess it up, or because you've been battle tested, right? Where it's like, okay, what did I do wrong there? Oh, you know what? I didn't vet the sponsor. I didn't look at anything. But the worst case scenario is you're gonna lose your money. And if you go into it with that mindset, I agree with you. And I joke around and I tell people, listen, the worst thing you're going to do here is you're going to lose your money. So invest what you feel like you don't care about, or not that it could be $5,000, it could be 5 million. It doesn't matter. But I tell people all the time that, whether it's investing with us or investing with somebody else, how do you know if it's a good deal or a bad deal? You don't. And if it's your first time doing it, it's like anything else. You got to put your toe in the water and test it out. So when people ask me, the first deal you bought, how do you know it was right or wrong? And the answer is I had no idea. I took a shot. Whether you buy your own duplex and you think it's going to cash flow, or whether you invest $50,000 in a $5 million syndication, there's no right or wrong way to do it. But doing it will just it's one level of accreditation from a standpoint of when you're talking to another investor, you have a battle story to tell them. When you're looking at a deal, you could say, oh, wait, this looks very similar. It was in the same market that I did it once before. And so I think it's another unique perspective that people don't talk about. But I do think there's a lot of, validity in just doing it and seeing what happens. And when you first start, you have no other options, more or less.
Yeah, it's like we're playing a game of, was it Minesweeper? When we're like just clicking the button, and maybe if you don't have 50 G's to throw at it, you only get one slot at it, and you pick the red mine. That's awesome, right? People want to know who the shyster is out there, and I would like to know. If anybody knows, shoot me an email. I'd like to know. I trade who's in my burn book.
No, 100%. I mean, that's the power of the network. Because as big as the commercial real estate and real estate investing world is, when you really break it down, it's relatively small. And if you do the wrong thing once, that's going to get out there. And I was talking to my cousin the other day, and he was talking about investing, and he's like, I got 25 grand. What should I do? I said, go on a website and invest 5 grand into 5 deals. See what happens. See, what you like about it, what you didn't like about it. But you're right. If there's someone out there not doing the right thing, let me know, right? Because then it's ammunition from both standpoints, from the investor standpoint and from the sponsor standpoint, right? You're looking at saying, oh, wow, another one of those deals. Like, I'll just pencil that for when it fails. So it's important to network and to take gambles and to take shots.
Yeah. So I have a question. When you were transitioning to more of the passive investing LP side of things, what was your thought process on giving up control of your money versus having your own deals that, you have control over? You can decide whether to sell, you can decide whether to hold, refinance, things like that. How did you deal with that?
Yeah, I mean, initially when I was going from a direct owner to more of a passive, I went to this phase, and I didn't go through it for very long, maybe about 6 months, where I was overcome by ego, right? I wanted to be the guy, right?
Mm-hmm.
And there was part of it is like you see these guys running these big deals, and you're like, oh, that's cool. So secretly you want that, right? Aside from all keeping the whole deal for yourself, having control. But, me and my partner, we wanted to pull our money together and just go buy a 50 or 70 unit in Dallas. And because that was all the money we had. But then when we started to analyze deals, and it just took about a 6-month process of kind of going through enough and realizing that these deals suck, right? Like every mom and pop investor can't get above that 100, 200 unit mark. And we're competing with them, and then the pricing is worse. It didn't strike home until we we're doing this for quite a while, and then the property manager that we were going to use was just like, yeah, man, like the pricing sucks. It doesn't work because there's so many other loonies like trying to do the same thing. And this is where, I mean, we could, and the second thing that really knocked us out was we need other people on our sponsorship team who had Fannie Mae, Freddie Mac experience. Because I like stabilized deals. So I got to go after, non-recourse debt, and you need the Fannie Mae, Freddie Mac cards to do that. So that was kind of the straw that broke the camel's back. But, it's just the pricing doesn't work until you get above 60, or actually certainly over 120 units. I mean, I have a 50 something unit, and that thing is just, it's hard because we have more of a residential property manager, but everybody talks about like the 60 units is the threshold where you can get the property manager in the office, which is great. But to me, you really need their right arm person, which is the dude driving around the golf cart that knocks out little work orders without having to pay a third party. That's the person that's actually going to make a change, a difference, right? Having somebody just sit in the office all day long isn't going to do much. So I went through that situation, and then I started to get it. That's where the network came in. I started to get, assimilate and kind of absorb their mentality, which was more, all right, you're giving up control, but you're getting back in so much more in terms of diversification. Now you can just spread your money around so much, different partners, different deals. And just, to me, that gain was way more than what I got just by having that little ego boost of I did everything.
Gotcha. So then, if I'm hearing you right, basically what you're saying is because you're so diversified across assets, operators, regions, you feel that any control you've given up is just diversified away and not really a large risk for you.
Right. I mean, I grew up knowing that you have to give up something to get something, right? I didn't get everything I wanted. I mean, it's just like some investors, they want cash flow and capital appreciation. It's like, dude, you either got a development deal where you get no cash flow for a few years and get a big pop, or you get cash flow. I mean, you can't have everything. And this is just another example where you can't have it all. You got to make some decisions in life.
Yeah, I hear you. So how do you make sure that you're not too exposed to any one element of those different things that we just spoke about?
I would say just the way I've done it, and I still do it, as I kind of dollar cost average. I don't just like blow all my money in like 6 months. I guess in the beginning I kind of did because I had a lot of cash because I had sold some properties. But especially today, I kind of go into a deal every quarter. Just it's more, it's like a baseball player. Like I'll swing at it every 4 pitches. There might be some good ones. Probably won't be some good. I mean, if it's good, I'll swing twice in a row. But for the most part, I'm kind of controlled, and I kind of just dollar cost average my way through this. But I'm at a point where my deal flow is pretty consistent, and I kind of know where the water line is. I know what a good pitch is. I know what my buy box is.
Gotcha. So do you feel like you're almost investing in like the commercial real estate market versus particular deals, or do you still feel like you're investing in particular deals at this point?
I mean, I'm invested in the commercial markets that I think are strong. Like I don't invest in retail or assisted living. I mean, I have one deal in assisted living, but those are obviously markets that are taking a beating with this whole COVID stuff. But at the end of the day, I'd like to think that I invest in individual deals, right? Outliers, right? We have a lot of investors who spew off a lot of statistics, more macro statistics, but it's always the sub-market, like where is it in the neighborhood, which transcends all data. I mean, that's the whole point. You want to buy outliers, right? I mean, hopefully that's how people think of their spouse, right? It's not an average guy or gal, right? But someone who's kind of special, who would have figured, right?
Exactly.
But I'd, find those deals once a quarter.
Oh, that's good. So how do you then, when you're looking at deals and you're looking at the submarkets and some of the stuff that you think pops out, what are things that attract you? What are things that attract your eye? Are there certain things you look for? Are there certain things you just totally remove? What are some of those?
Yeah, so my secret is I don't really fall in love with a deal. I just put in my spreadsheet and I analyze the property myself, with my own assumptions. I get the P&Ls and the rent rolls. Again, this is something that most LPs can't do. So they're going to have to go on a date and fall in love and like the smell, like what they look at.
Mm-hmm.
But I try and take that out of the equation. I look at it from the numbers perspective first and see how fat it is. And are the sponsors taking, enough cut or not enough, or are they getting greedy with, and then I look at like the splits and then the fees. But from the project level, is the deal fat enough first?
Mhm.